In the alternate version of exercise 8-14, we're presented with a scenario where Ogie Company has purchased equipment for $280,000 that is expected to last them 4 years. Now, we're not worried about the journal entry to record the purchase of the equipment, nor are we worried about depreciation. We've already tackled depreciation in past videos. What we're concerned with is some additional cost over that 4-year life that we incur related to the equipment. Do we record it as an asset? Do we record it as an expense? Do we ignore it? What do we do with those additional costs? Just like in your own personal life, if you own a vehicle, you have an expectation beyond the initial cost of the vehicle, there's going to be additional items over time. At minimum, you're buying gas to fill the tank to keep that vehicle running. You're doing oil changes. You're doing routine maintenance like rotating the tires. On the other hand, you might invest in a set of tires that allows your vehicle to perform better. You might have a breakdown and have to replace the engine or transmission. So just like in your own personal life with a vehicle, a company has an expectation that there's going to be cost over the life, and how do they handle that? So let's start going through these one by one. During the second year, the company paid $30,000 cash for a new component expected to increase the equipment's productivity by 10% a year. So for example, it might, whatever this piece of equipment is, maybe it cuts parts out of steel, it allows that company to yield 10% more parts in a year. So it made sense. They're going to pay $30,000 in cash for that. Now, going according to our chapter, let's think about what overall category that fits within. Is it a revenue expenditure or a capital expenditure? This is something increasing productivity, so it's going to be considered a capital expenditure. In particular, the type of capital expenditure is a betterment. Keep in mind, betterments either make that item either more efficient or more productive, so that definitely fits within this category. And being a capital expenditure, we debit it to some type of an asset account. In particular, since this is equipment, we'll debit it to the asset account equipment, a debit of $30,000, also crediting cash for $30,000. Our next amount is in the third year, we're going to have to pay $5,000 cash for normal repairs necessary to keep the equipment in good working order. This fits within the category of a revenue expenditure. In particular, it's just considered an ordinary repair, something just to keep it in good operating condition. Just like your vehicle, that would be an oil change or rotating your tires. Just keep that vehicle in good operating condition. This is considered an ordinary repair or revenue expenditure. In that category, we debit an expense account. So we're going to debit something like repairs expense for $5,000, also crediting cash for $5,000. Our last cost over that fourth year happens during the fourth year. We're going to pay $18,000 in repairs. Now you might stop there and think, well, in situation number 2, when we said repairs, we expensed it. So I would debit repairs expense, but let's keep reading. The repairs that were done are expected to increase the useful life of the equipment from 4 years to 5 years. Previously thought it was going to last 4 years. We were able to do some repairs not just to get it back into operating condition, but to actually extend the life. That also would be considered to be a capital expenditure. In particular, it's called an extraordinary repair. So not an ordinary repair, an extraordinary repair. That's going to be also debited to an asset account just like a betterment. So we're going to debit equipment for $18,000 and credit cash also for $18,000.